Hey, listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available? Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Welcome, everybody. Today on SED, we've got an interview with CEO Doug Emsley of SSC Security Services. First off, I got to remind everybody it's Tuesday, July 16th. SSC Security Services trades under the symbol SECU on the Venture Exchange, or SECUF on the OTC. Company has roughly 18.9 million shares outstanding. And closed today at $2.46 for roughly a $46 million market cap. I'd like to say hi to Doug. And Doug, I've got your presentation all set up, so why don't I just turn it over to you and let you go.
Thanks, Paul. I appreciate it, and welcome everyone on the phone. And my presentation will be brief. And as Paul knows and Trevor both know, it's our story is pretty simple. And I actually happen to think that's part of its appeal, both now and into the future, but it's certainly part of its appeal from a business standpoint. I've been in complicated businesses, and I've been in complex businesses, and I've been in simple businesses. And simple businesses, I think they have an advantage. Properly done, they have an advantage, especially in this market today, because there's lots of weird, anything from vaporware going on to sort of weird and complicated stories, all of which may have their own merit. But in our case, we're a pretty simple outfit. We're a security company. We provide physical security. We provide electronic security, which is cameras and access control systems, and we provide cyber security. And basically, we put people on sites. We charge the client more for them than we pay, and we make an edge. It's kind of like a little pipeline, and that's what we do. It's not complicated, but I will walk you through the story, tell you about how we allocate our capital. I think that's part of our secret sauce in our little venture here, and I can tell you about the industry as much as you'd like to hear. But I'll just kind of walk briefly through the presentation. I normally do this in about 4 minutes. There's one or two slides which I'll spend a moment on, but basically it's standard stuff. And I'm not sure what I'm showing on my screen here, but this one's one of my favorites. I'm kidding. I'll just keep moving right along here. Our profile one is basically says, look, we're set up like this. We have the mothership, which is SSC. And we have a couple of subsidiaries underneath us where we basically house the operating companies of the operation. We have about 3,000 employees across the country, which probably makes us the fourth or fifth largest in the country in terms of security companies. And that's from the big guys down to sort of whatever. There's hundreds and hundreds of security companies. But we are the only Canadian publicly traded security company out there. So that's what that slide tells you. Complex? No. Acquisitions to date, just a bit of a timeline. Back in February of 2021, we acquired a company called SRG Security Resource Group. That was our first acquisition in the business, and paid about $20 million for that. It was a good deal. That came with a cyber division, which is nicely profitable. And then in July of 2021, later on that month, we bought the assets of a company called Impact Security Group. That was an asset deal, nice little bolt-on, and buttressed our existing operations, and we got some nicely accretive EBITDA. And then the last piece in the puzzle so far, because we continue to make deals and do deals and buy bolt-on operations, was the acquisition of Logix Security. Logix was a fairly substantial operation. This was transformational for us. This company, when we combine everything together, brings us to a total, as I say, of about 3,000 employees, and we do about 120 million in sales. Lots and lots of transactions, And the best part about this is, with all of this right now, we have deployed probably half our balance sheet into deals, into acquiring companies in the security business. And we'll talk more about this as we go forward, but we have no debt. We got lots of cash in the bank. This is our growth strategy. Pretty straightforward stuff. Just as a bit of a story, we originally started our company, SSC, as was an agriculture streaming company, and we exited that business a couple of years ago, and went through a strategic alternatives process. And in that process, we decided that we were going to get out of that business and morphed into the security business. And so we have what we call some legacy assets. That's point number one. We basically repatriated all of our cash out of the ag sector, and started to deploy that balance sheet, half of which has been deployed into the security sector. I would hazard to say that we're probably one of the best capitalized companies in Canada in the security business. We've got a strong balance sheet, which allows us to chase rainbows and seek larger national contracts, which I'll talk more about later. Cybersecurity. Part of our business is cybersecurity. It's a growing business. Clearly, it's a growing business. It's pretty much on everybody's mind. Cyber and cyber attacks. Our guys are expert in managing networks and providing managed security services for clients certainly across the country, and in some cases outside the country. It's a small part of our business, but it's a nicely profitable part of our business. So we're growing those. I'm not out there buying cybersecurity firms because they're too expensive, but we have a nice sized operation right now. It's about $8 million, $7-8 million in revenue, and we're growing that organically. I could buy more cybersecurity companies, but you'd have to overpay. And the problem is, all day long, your assets go up and down the elevator, and it's a very risky kind of business to buy. So my preference is to grow our business internally and fund it internally, and on the cybersecurity side, and that's what we're doing. Other acquisitions, point number 3 is, I've already mentioned, we bought Impact Security recently as well. We bought Logic Security, and that's brought us to the size that we are now, for the most part. One of the other angles on our growth strategy is cross-selling. When we buy companies, we look for synergies, but we also look to cross-sell into the client list that we get when we buy. So, for example, we bought Logix. When we bought Logix, we got a long list of pretty substantial clients across the country, across the world, actually. And we were able to take our other services, all of our services, and sell into those, except for, and this is one of the areas which has not worked out, our cybersecurity division. And I've mentioned this to Paul and to Trevor. When we bought Logix and said, okay, look, we've got this big long list of clients now that we can cross-sell into, one of the things that became evident pretty quickly to us, and it was a test to see, but was the people who are the acquisition or the buyers in companies for physical security services are different than the guys who are the buyers for IT and cyber security services. So taking that same client list and trying to sell our physical security clients cybersecurity services has not been super. I won't say unsuccessful. We've actually had some decent success, but it hasn't been a slam dunk. But we do get the odd little bit of new business when we approach our clients, or if our physical security clients end up having an issue. On the cybersecurity side, they know that we do that business, and we've had some calls, and we've had some nice profitable business fall out of the tree on that basis. But for the most part, it's not a direct cross sell. What is a better direct cross sell is the physical security services which is the vast majority of our business, probably 85% of our business, is a good prospect for the sale of electronic security services. It's really the future of our industry, the opportunity to combine physical security services with electronic security services, i.e. man guard services with access control systems and cameras and that sort of thing. I can create a product which is less costly for my clients and more profitable for us by combining and integrating electronic security services with physical security services. So just to frame that again, physical security services represents about 85% of our business. Cyber represents about 7 or 8% of our business, and electronic security services also represents about 7 or 8% of our business. The cross-selling that happens and will continue to happen, I think, going into the future, is between our electronic security and our physical security business. Cyber, we can cross-sell from time to time, but honestly, it is not the easiest sell, and it's not a direct line of contact. We have to sell to a different part of the organization, typically on the cyber side. But we still are successful doing that, and have been successful doing that. I'm going to just keep going down the list here. I like to show this chart because it shows up nicely to the right. This shows our quarterly revenue. We're growing nicely. I think we were just named by the Globe and Mail. I don't know if we're allowed to. I think we were just named by the Globe and Mail as one of the fastest growing small cap companies in the security business, operated by people with a size 11 shoe. I don't know what the actual credentials are, but we've been given some award that says, hey, we're one of the fastest growing companies in this small cap sector. This is a chart that basically shows you how we've been doing. If you look at the 6-month side of things, we've got another quarter that's coming up pretty good, or coming up pretty quick. But this is the most recent data that we've published. You can see from 23 to 24, all our numbers are up. Revenue's up. Cost of sales is sort of nicely in where we want it to be. Our gross profit is we're making money nicely, and our gross margin is nicely in that 14 to 15% range, which I'll talk more about later. But that's really where we like to be. Adjusted EBITDA. We're a cash business. At the end of the day, you'll hear me talk about this all day long. We're cash. I've been in lots of different businesses where we've had lots of debt, where we've had derivatives, you name it. I like cash. So ours is a cash business. We have lots of cash on our books. We measure our success with essentially our adjusted EBITDA, and that's the cash in our business. And you can see from last year, we are nicely growing our adjusted EBITDA, and that's what we continue to focus on, and will continue to focus on. You'll recognize some of these names. These are just a long list showing you some of the customers that we've got. The next slide. This is a busy slide, but a couple of things here worthy of note, I think, is on the top right corner here. We pay a dividend. We pay a small dividend. It's not a lot, but we pay it. We pay it consistently. I can tell you that about a year or so ago, we were running at about a 100% dividend payout ratio. With the deployment of about half of our balance sheet right now, we're probably running, again, from a cash standpoint, we're running at about a 40%, sub 40% dividend payout ratio, which I like. I mean, we're a service business. We don't have a lot of capital requirements for CapEx and things like that. And so when we make money, it belongs to the shareholders. I don't mind pushing it out. And right now, with half of our balance sheet deployed, we're able to pay nicely a small dividend here. So you're paid to wait while the market sits around and decides whether or not our value will ever sort of increase to the level where it's supposed to be. Top left corner here, you see our continuing rising insider ownership. We have a strong insider ownership base. I'm the largest shareholder. We have a couple of other large-ish shareholders, but we own and control probably close to 40% of the company. I've never sold a share. One day I guess I'll have to, if my wife wants a new purse or something. But I haven't sold any shares. They continue to sit there, and we're completely aligned in terms of creating shareholder value, which is what we do. Right here, this one, can you see my cursor moving on this stuff, Paul? So what this shows is we have an active NCIB, and it's in part because we believe that the shares are undervalued, and while they're undervalued, we're continuing to buy back shares over time. We create a bit of a market and some liquidity for the shares, but that's what this is designed to show. I can tell you that over the past number of years, we've bought back almost 35-40% of the shares. This chart doesn't go quite that far back, but we had more than 30 million shares at one point. But we bought back a lot of our shares, and I think that's been a decent use of our capital. When I look at our business and I think, okay, the way we make money, we're a high volume, low margin business. That's what we do, but we're good at it. But one of the things that we can do, I can make a double digit return for my shareholders by buying back our shares at these lower prices. So we do allocate, we're good capital allocators. We do allocate our capital, some of our capital, to buying back shares. And this one on the right is a bit of it's a goofy chart. I'm gonna take that one off there at some point because it doesn't really tell much of a story other than it shows you our book value plus cumulative dividends paid to date historically. Here, this is an interesting slide for anybody that's interested in cash. The whole story here is the legacy assets are getting wound up. That money is getting brought back into the company. But this little area down here, this little dotted area, so over time, we have written down the legacy assets that we haven't yet collected, and it's down to just a few $1 million. We've written those down to virtually nothing. But as we collect those, we have a couple that are collections in court and stuff like that. When that happens, that there will be write-ups because the security that we had for the loans that we were making in our ag streaming business were secured by farmland. As you probably know, as many of you probably know, the value of farmland has been increasing, so the value of our security is increasing. So as these run off and we collect on our security, the actual security has increased and improved in value. So we think we're going to recapture a bunch of this write-down stuff that we took here. So the money that we've got in is about $7 or $8 million. We carry it on the books for. Probably that's closer to $10 to $12 million. That's not selective disclosure. We tell everybody that. I mean, there's some latent value there that will fall to the benefit of shareholders. And I count that as real cash because I just know it's going to come in. It's just going to take time. If I had one share, if I was in an elevator with you and I had one share and I could or one slide, I'd leave you with, this would be it. This is what we do. We're pretty good capital allocators. We grow. Here's what we do. We spend money on M&A. We're very disciplined about that. We pay 4 to 6 times, and typically we're looking for an extra turn or two of EBITDA once the transaction is closed. So if we paid 5 times, by the time it's done and integrated, it's probably a 3 times number. So we're disciplined about M&A. We've got a national footprint so that we can nicely tuck in deals and create some synergies. Although I must tell you, I'm a bit of a skeptic on all matters synergy. I don't believe so much in the synergy myth, but we're disciplined about making sure that when we buy, we can bolt it onto the side and we will collect some synergies. And usually it's at least one additional turn of EBITDA. So M&A is part of our growth strategy, and our plan, just to back up for 1 sec, our plan is to, in 3 to 5 years, to be twice the size that we are right now, using and deploying our existing balance sheet in these buckets. One is M&A. The other is we're buying back shares, as I've already mentioned. We have an active NCIB. It's a tool that we keep using out there. Organic growth has been pretty good. And the reason I put that in our capital allocation side of things is because we fund our own receivables. When I was a young guy, there was a guy, and I don't know if I told you this story, Paul and Trevor, but when I was a young guy and I was starting out in business, there was an older fellow who was on my board, and he was an owner of the John Deere dealerships in Saskatchewan. Pretty wealthy guy in his own right. But you know, it was old money, and he'd made good money. But if you ever want to own a business in Saskatchewan, you want to own the John Deere dealerships. But he didn't say much in our meetings, but when he did, the earth would move, right? It was interesting. And as we were talking about receivables one day, way back when we were early on in our business, he said, "You know, you're making money when you're funding your own receivables." And so that has stuck with me. And we pay a lot of attention to our receivables. We make sure that we keep them tight and we collect on them. But as a company, we fund our own receivables, and that actually does use up some cash. You get a $12 million contract. You get, first thing you got to do is put up about $3 million worth of cash in order to fund that receivable. So lots of companies don't do that in our business. First thing they'll do is they'll factor that receivable, or they'll go to the bank and borrow, and suddenly you got a spreadsheet jockey at 20 years old is running your company. It's not what we like to do. We like to fund our own receivables, and so we do that. We pursue actively organic growth. We're looking for 10 to 15% growth from an organic standpoint of our existing book of business, plus M&A. Whatever comes there is good and adds on. We buy back shares, and last but not least, we continue to pay a quarterly dividend. It's small, but we've paid it every year for the last number of years. And as I say, we're now sitting there, and our payout ratio is I think it's sub 40%. If it isn't, it will become next quarter. But we're piling up cash, so I like to be in that position because unless we have a use for that cash, that's what we should be doing with it. Here you see our smiling faces. That's me there on the left. And there's Blair Ross, partner of mine for many, many, many years, business partner. He's our operating guy. He's second to none in the industry. We got Brett Leonard. He's a financial guy. We make fun at his expense all the time. He's an accountant. That makes it even easier. But he's our CFO. He's a good guy, has got lots of experience, and brings a great he brings a sort of a good breadth of experience to the table. It's our board of directors. I chair the board, and I'm CEO. I know that probably violates a couple of the governance rules out there, but I don't really care. We run it like it's our own, right? And so we have a small group. We have a lead director who's probably one of the lead governance people in the country, David Brown. He was the former chair of the Ontario Securities Commission. This is a senior guy, probably one of the senior lawyers in the country. Lauren Hepworth is a former finance minister. He's just a tremendously smart individual, and is a good businessman, even with all of his sort of quasi-government experience. What he brings is a level of practicality to our board, which is second to none. Brad Farquhar is the former CFO of the company and has moved on. Last year he moved on. I kept him as long as I could, but he always had in his world a view that he wanted to move on and run sort of various missions in other parts of the world. So he's the chairman of a mission. It's called SIM International, which is an international mission-based operation. And he stepped out to do that, but he's still on our board. Still has a great mind, and was one of the founders of the company. Lori Powers is brand new. She was a partner of mine in another business. Is probably one of the smartest directors I know. Doesn't like to speak just to hear the sound of her own voice, but when she does, everybody writes it down. So she's really, really good. So we have a strong board, is my point. And from a governance standpoint, these are senior level people. Just going to keep going here. This is we're coming down to the end. This is our corporate profile. This shows you a bit of who the top shareholders are. From our office, head office in Regina, with about a wedge or maybe a 3-wood, we can probably hit all of these, 40 to 50% of our shareholders, and that's the list of them there. That's us. That's how you find us. And did I mention that we have no debt? We don't do debt. And if we do, it'll only be for a short period of time, but we measure ourselves based on annual growth of 10 to 15% EBITDA. There you are, Paul.
Perfect. Great job there, Doug. So a number of questions. Before I jump into questions, I want to remind everybody, if you've got a question you'd like me to ask Doug, please use the chat function. Of course, I will ask that question. Doug, so various different sort of products and services that you offer right now. The couple that I'm most interested in, I think we're all very familiar with those live guards we see at either construction sites or different facilities. But when you say cybersecurity, give us an example of how you operate that service for a client. Like what are you either what kind of software are you implementing, or what is it that you actually do to protect their assets?
So the cyber operation that we have a former senior IBM guy who is our partner and runs that division for us. I'm not the technical guy, so I won't go too far down that pathway, but we use all of the major tools out there to monitor networks, to assist in at times and in places when there are attacks on infrastructure. Our guys, we have a critical incident response team, which is a bunch of guys with letters behind their name who will help
Mhm.
and respond in the event of a ransomware attack or a denial of service attack. So we protect networks for large operations and government operations,
Mhm.
and we have all the tools to do that with, from endpoint right into sort of server tools that we use to protect. But we also have I think it's about 60 guys and gals who are the ones who are managing the monitoring of those networks and the provision of the I'm going to call it the high-end cyber security services that we offer, that are very very expensive, very profitable, but also it's a good book of business. It runs at about, I think I said, about $7 or $8 million.
Mhm.
Um, the gross margins are closer to 40 to 45%. The EBITDA margin is probably 15 to 20% on that money.
Mhm.
So that's good business. We like it. We've been doing it for a long time.
Mhm.
Um, and as I say, we've had opportunities to buy cyber
Mhm.
businesses, but there's so many cow pies there. I mean, we don't do software.
Mhm.
We don't we're not resellers of equipment.
Mhm.
What we provide is services and smart guy services to monitor networks. So we provide the managed security services for our clients. We'll have the odd sort of deal where we'll sell some software on behalf of a vendor, but we deal with all of the vendors,
Mhm.
and our operation is tight. And the group that we've got, the 70 guys that we have profitably working in that area, is probably one of the largest cyber security operations in the country.
Mhm.
Um, but I haven't reached out to try and buy more of them.
Mhm.
That's maybe not your question, but I haven't reached out to try and buy more of those services simply because they're so expensive. Guys are
Yeah.
paying multiples of revenue, and in my world, like, we're used to making money. We're used to making cash, not making an
Mhm.
investment and waiting 50 years to get it.
Yeah.
We have to make money on the money that we invest, and so we are growing it organically. We've been successful doing that. We've got a good team. They can operate anywhere in the world, frankly, but it's mostly in Canada that they operate because they're all online. I never see them. Half of them I wouldn't recognize on the street. I mean,
Right.
but they're all over the country for us.
Mhm.
Anyway, that's a
And
bit of a long answer to your question, but
yeah, well, that's fine. So I mean, you touched on a little bit that how hard it is to sort of cross-sell cyber with the other services. So how do you grow this business organically? Do you have sales reps that go out and sell these services, or is it RFPs that you answer? How do you grow this one organically?
great question. It is to grow it organically. I mean, mostly it's from inbounds. Honestly,
Mhm.
it's a lot of our business that we get is from inbounds. We are careful about how much new business we take on because, I mean, you got to find these people that we use
Mhm.
are scarce as hen's teeth. They're very, very expensive. And so we have our base, we have a bit of a bench. And so to the extent that we get filled up, we stop taking on new business. We're always looking for people, we're always recruiting. So our organic growth is a bit of a function of the resources that we can get. We don't have any trouble growing our business. We're careful about it reputationally and being able to provide the service. We're very careful about what we'll take on.
Mhm.
But for the most part, we get inbounds. We don't have a sales force out there marketing that operation, other than
Mhm.
the guys that we've got out on sites are they're all kind of sales guys. I mean, a lot of our business is from existing, a lot of our new business is regularly from existing clients who have a project and they reach out to us because we're pretty good at what we do. But we don't have an overt sales force. That might change one day. But mostly it's responding to RFPs, dealing with our existing clients, and fielding inbounds.
Gotcha. So so many different sort of directions I can go here, but let's go to the M&A side. You've made a couple acquisitions here clearly over the last couple of years. Maybe give us a sense of what's the M&A landscape look like out there, and are you predominantly looking in Canada? Are you looking outside Canada? Where's your area of search right now?
Canada. I have not been looking in the U.S. That's a step. If we do it, we would do something in the U.S. if the right opportunity came along. But Paul, we're very disciplined. I mean, there's always somebody trying to sell and somebody trying to retire, and various sizes. Just to shape the industry for you, there are sort of three layers, and I think I've described this to you guys maybe once before, but not to bore you. There are three layers. There's the big guys. These are the guys that have the hundreds and hundreds of thousands of employees, multi-billion-dollar operations, operate all over the world. That'd be the Gardas and the Allieds and the Securitas, those kinds of companies. They are companies that ultimately are prospects for us to be able to sell to, because they'll go on a buying bender. I sold once to Securitas at a company sort of much smaller than ours here, but sold it to Securitas because they decided that they wanted to just bulk up and they wanted to buy. And when they decide that they're going to buy, they just step into the market and they pay. So that's the big guys. Then there's the guys that are sort of, I would say, from the $100 million size to the $500 million size, which is where we are. We're in that group. There's probably 4 or 5 of those in Canada. We're the best funded of those. They would be prospects and targets from our standpoint to acquire at the right time. Again, we're not going to overpay, but they would be prospects that we would acquire. And then they're below that. There's hundreds and hundreds of small, what we call, I mean, when a guy has a 50-man shop, he doesn't have a business, he has a job, because he basically has got enough money to sort of run his overhead. And so we look at those guys and we say, okay, we've got places all across the country where we could buy these guys, pay cash because we've got the cash to do it, and we can bolt them onto the side of our existing operations, usually take out a layer of management because we don't need to double up. But you got to be careful with that. But those bolt-on opportunities are out there. You have to find the right person at the right time that wants to sell. And we know the industry pretty well. We've been doing it for 30 years. We know where there are opportunities, and we get lots of inbounds on that basis. But we're disciplined about sort of the multiple that we'll pay and how we assess that multiple, because everybody's always got stars in their eyes about what they can get for their business, and sometimes they gotta come by and then go away a couple of times and come back. So that's the shape of the industry. There's the small guys, hundreds of those. There's the mid-sized guys. That's us, and we've got acquisition opportunities in both of those areas. I don't know that I would make an offer for one of the really, really big guys, but really what we see ourselves as doing is dressing the bride for one day when the Allied wakes up or Securitas wakes up and they say, hey, we want to buy an efficient organization across the country of Canada, and we'll be a target.
Yeah. And what sort of prices do you guys pay? I think you mentioned it a little bit in the presentation, but when you're looking at something like this, does it stretch a little bit based on maybe something is a little more technology heavy, or does it, are you numbers disciplined, or what can you say?
We're numbers disciplined. We're pretty careful, 4 to 6 times EBITDA. Again, I got to usually find a turn of EBITDA there in synergies. So that's kind of what but everybody says that. Everybody says 4 to 6 times, but you got to be careful about how you calculate EBITDA and sort of what's the number that you put the multiple on. And so we take trailing 12 months, and you show us an EBITDA, we'll consider 4 to 6 times, depending on sort of the risk and the expiries of the clients that you've got and the contracts that you've got. All of that works out to sort of determine the multiple. And then we look at the management. I'm not interested in buying the shite out there. There's lots of that. We're trying to sort of bolt on and buttress our organization in the various places that we are across the country with good shops where we can usually gather up a couple of people. It's not so much about getting rid of people, it's about getting good people. So we try to do that, but we still have to get the synergies.
Gotcha. I'll come back to some of this stuff in a sec, but let's go to sort of capital allocation. You guys are basically doing a little bit of everything, right? You're buying back stock, you're paying dividends, you're acquiring companies, you've got plenty of cash. I want to sort of focus on the dividend. You're a small company, and not too many small companies actually issue a dividend to start with. But I'm trying to really wrap my head around is that the best use of capital? Like I can't help but think that getting more aggressive on buying back stock seems to actually, in my mind, be a better return of capital to existing shareholders that want to hold on to the stock. But argue with me. Like tell me why you guys have a dividend right now.
It goes back to many years ago when we started our company. We were out there humping the market about, sort of what a great stock we were and telling our story. And we wanted to expand the number of potential buyers of our stock that we could attract. So we got counseled by a bunch of investment bankers who said, look, there are some funds that simply you're not on the list because they can't unless there's a dividend. It doesn't have to be big, but there has to be a dividend. And so you can open up, and I think the number that they told us was there was probably 140,000 new potential shareholders. Some of them were funds or whatever that we would be opening ourselves up to if we just issued a dividend. And that was on the screen. Somebody could say, okay, well, I can put my money into it, or at least I can consider that. That's how it got started. So we did that. We put up it's a small dividend. It wasn't sort of eating into our capital or blowing out our capital. So we put it out. It was small, and we've never taken it back. I don't think we will withdraw it. I mean, I get the point that is it the best use of capital? If I had more acquisitions that I could make where I needed capital, I'd have no problem securing additional funds. Now we're not going to sell our shares for goofy numbers, but the dividend wouldn't be the first place I'd go to sort of unwind that. In particular, because if we're going to be right now we're about $130 million revenue company. If we double the size, we'll be $250 million in size. We should be able to look at the cash that we're throwing off and decide, okay, if you're not using it up in M&A, and there isn't your stock price is up high enough. I mean, maybe there's an alternative where you start giving more of that money back, where you would increase the dividend. We haven't done any of that, but we're mindful of that opportunity. Right now, I think the most important thing about our dividend is that it's kind of obvious. It's kind of odd that we have one. I accept that, but it's not so big that it's a problem for sure. And in particular, right now, with the growth that we've got, we can nicely afford it, and it'll be somewhere between 30 and 40% dividend payout ratio is an easy number to sort of manage. And we're just going to continue to stack up cash, and so we'll have to decide what we do with it. I'm not forecasting or portending anything, but the cash belongs. I'm the biggest shareholder, so I get that. I mean, the cash belongs to the shareholders. If you haven't got a use for it, then you should figure out how you can. And you can give money back to your shareholders by NCIB and by dividends. But as we grow, we're a service company. We don't have a need for a lot of CapEx. Once we get fully deployed, we'll be looking at all of those questions.
No, gotcha. It's funny when like one of the, oh, how do I say it? One of the downsides is the fact you issue a dividend compared to so many companies that don't even have the cash. You're not even profitable. So it's nice you even have that
We had that
sort of
option. Yeah.
problem to think about, right? So
Yeah.
no, good on you. Well, okay, so let's talk about some, I'd almost say other potential uses of capital. Now, there's a company, there's a publicly listed company that we follow very closely called Zedcor. We sort of, you and I
Yep.
talked a little bit about the company. Now you guys kind of do something similar, or you have the potential to do something similar. And I mean, that seems like a great growth opportunity. Maybe let's talk about some of your growth opportunities that you have outside of kind of what you're currently doing, or maybe an offshoot of what you're currently doing.
We know Zedcor. I don't know the guys personally.
Mhm.
We watched with interest as they started that company. It's a great idea. um, they're in cash raising mode typically because they've got capital requirements, capital expenditure requirements. They do remote video monitoring. They've got good cameras. They've got a great product, and they've got a good name, and I think some really good guys. They're Westerners, so we particularly like them on that basis. Um, and in our business, we do remote video monitoring, not solely, but part of what we do. We put up cameras in remote locations, and we will monitor those cameras. We are looking at expanding that footprint, expanding that business because I like the margins that they're getting. Plus, the other thing that we can do with 3,000 employees spread across the country, we have an ability to not just simply remote video monitor, and we have a monitoring station. We have all of that stuff right now that we do, but we have the ability to respond. So, if, for example, you're doing a construction site in Mississauga, if we put a camera up on a site similar to their camera system, we have a few of those, not many, but if we put one of those cameras up and we see something bad, we can respond. We've got 60 cars on the road in the Greater Toronto area. So we'd have somebody that could be there, frankly, faster than the police. So we think the product that we can ultimately offer is different. Now, if you're talking about a pipeline in northern Alberta, well, everybody's got the same response issue, and so we can all offer the same remote video monitoring. Response is a bit of a problem, but in populated areas with the footprint that we've got, we think we have a nice opportunity to grow our business in the remote video monitoring business. Not unlike what Zedcor is doing, but with some additional capacity because we have so many vehicles on the road that can respond as well.
Yeah, and what I keep thinking is you actually have the monitoring sort of infrastructure. So layering on an offering like this is not that much of an effort for you guys. There's obviously some CapEx in getting that out, but you have all the monitoring infrastructure. You have people on the street, like you said, that can respond.
Yeah.
So in some ways, you can actually offer better service in sort of the more populated areas where you can get a car out. But I keep thinking that's an interesting use of capital to be able to expand some of those opportunities.
Yeah, and so the way I slice it is on the remote video monitoring side. So when you look at Zedcor's business, they do remote video monitoring, which is in areas where there isn't traffic and it's pipelines. Although I think they don't do as much on the pipeline side. I don't know their business in detail, but the remote stuff, we can offer the same product. We can buy their cameras and put them on site. We can certainly monitor them. That's no issue. It's the response side. So when you get into the populated areas, where we think there are some great opportunities for these stationary cameras and these high visibility, sort of high location type cameras, we can respond as well. Increasingly, it's becoming, because cops don't like to respond to these kinds of things, and half the time it's a false alarm or something like that. So we think with the mobile division that we have in our company, for example, Southern Ontario, we can respond very quickly, and we think that's an advantage over what the guys at Zedcor have got. Although they're a very good company, and I'm not dissing them at all. It's just different, right?
Yeah.
And the other, because your question, I think, was premised on sort of an interesting opportunity for the two of you to sort of stare at each other. We're always open to that kind of thing.
Mhm.
I like these guys. I like their business model. I like their margins, and
Mhm.
we'll either join up with them or we'll do it ourselves.
Yeah.
And we've got that ability. We probably have a leg up to do that because of our scale right now
Yeah.
and our balance sheet.
Yeah. Exactly. No, that was my whole point. You said it well there.
Yeah.
Okay, let's take a couple questions that come in here. I'll just answer them as I read them here. Jesus says, how much is growing each segment, or I guess how much growth are we seeing in each segment, and what is the gross margin of each? If you can give us sort of a little bit of
Sure.
info there.
So let's take the protective services division. The protective services division, our gross margins are about 15%, and we take home about 5 to 7% of that in EBITDA. In the electronic service, and everybody's the same. Guys will lie and bullshit you and tell you that they're different, but they're not. We're good at it. I think a lot of people don't have these kinds of margins. But so that's physical guard service, and so we do that business across the country, and some less, some more, but that's our target. On the gross margin side for the electronic services, we're probably in the 20 to 25% range. These are just general numbers.
Mhm.
You can tell that's all public information. That's one of the advantages or disadvantages of being a publicly traded company.
Mhm.
It's all out there for everybody to see. And so the gross margins are higher, and we probably take home north of 10% EBITDA on that. On the cyber side, I mean, it's the margins are 40+% gross margins, and we probably keep about 20+% of that. So, and then when you weight them, like I say, we have $125 million worth of business this last year. 85% of that is guard business or physical, and probably the balance, the other 15% is split between cyber and electronic security services, with a little bit of an advantage to cyber.
Mhm.
So that's our business in a nutshell. There's no secrets. Like I say, we're boring and we're obvious and straightforward.
Well, making cash is not boring.
Yeah,
It's
I
not at
agree.
all. Yeah. But so you sort of mentioned earlier the fastest growing, it sounds like the fastest growing side of the business is really sort of that cyber and the electronic monitoring side. Can you give us an indication of kind of what kind of rates you think they're growing at?
Oh yeah, I shouldn't. If I left you with that impression, I didn't mean to. We would. So on the physical side, we've grown substantially organically. I mean, a lot of it is contract based, and so we bid on a big contract, and we got one here recently, which we bid on the contract. It was a $4 million contract turned into a $10 million contract when we ultimately signed it up. I mean, that's a big win, right?
Yeah.
I mean, and that's physical. That's providing people. It's doing what we do. We're very good at it. We know how to make money at it. On the electronic side, it won't bump as much, but the margins are better. That's okay. The cyber side is probably slower growth, but again, it's more nicely profitable. Where the opportunity is, I think in our business, if I was an investor and I'm sitting back looking at it and I'm saying, okay, what's the future of our business? It is the combination or the coming together of electronic security and physical security.
Right.
And I've given you, and I don't know if you want me to bore you with this again, but just very briefly, the way that works, like from a number standpoint, the way that works is if you put a 24/7 guard on somebody's site, and I'm making these numbers up a bit, but that's like $250,000 a year is what I would charge you as Mr. Property Manager for that building. You'd have a person there 24/7. And we provide mobile backup and support and all that kind of stuff. Now, you get pretty good service that way, but I could also sell to you, and we all the security companies out there compete on the same level. I can tell you when I compete with a Paragon or a Paladin or an Allied or a Guard or a Securitas, whenever I compete with any of those guys, we're within inches of each other in terms of the 250 number. But I can also say to you, look, I can give you an 8-hour guard at the front door, put cameras throughout your building. I'll finance them because I got a strong balance sheet. We'll monitor them. We've got mobile security roaming and can respond very quickly. We'll put an 8-hour guard at the front desk, and we'll respond if something happens on the 10th or 12th floor of your building, you know, the guy sitting at the front desk isn't going to know about it anyway right away. But if we're monitoring all those cameras, we can have somebody there as quickly as if they were sitting at the front desk. And so we can do that. We can put the cameras in, we can monitor them, we can give them a physical presence at the front door so that, you know, during the day they can sort of smile and shake hands with everybody coming in and out of the building. But we can give them that combined service, which is better security. It's a better security package. If I was an owner of a building, I mean, it's just it's much better, I think, than sort of a 24/7 person sitting there all the time. They, you know, they sleep sometimes, and they, you know, they're all sorts of things. I can give that service to somebody for, say, $150,000, and I can make more money doing that through the monitoring process, supplying of the cameras, and putting an 8-hour guard on the shift. That combination package, I think, is powerful. You have to market the hell out of that, though, because everybody says they can do that, but it takes a while to sort of for somebody to get their head around, you know, not having a 24/7 guard there. But when property managers in today's world are looking for ways to not cut their security budget by like 2%, which is what we all sort of compete on right now. But if you want a 25% or a 30% reduction, like, that's unheard of. This is the way to get it. And so I think it's the future.
Yeah. And I mean, the nice thing, and why I'm so interested in your business, is that you guys have all those assets basically right now. It's just a function of sort of executing on those and sort of getting that business. And I would imagine there's probably a lot of potential customers that are price conscious, so they're not getting live guards, and in some cases they're not getting anything right now because there isn't an offering that's sort of they can sort of afford until you get to something where it's more electronic and along these lines. So it could open up a significantly larger market.
Oh, that's exactly right. I mean, I think the market is seeing it. We have the pieces right now. If we can combine those pieces and market them even better to clients, we'll make more money. The clients will get better security and all of that. I'll tell you a little quick story about a guy in the condo security business across the country. They got 50 buildings across the country, and this is an owner of condo buildings, and they supply the service, and you know, we talked about reducing the costs, and his answer to me, I said, we can do some magic here with cameras and stuff like that. And he said, you know, I don't really care so much about the cost. I'm looking more at the livability of some of the condo units that we've got, and the rentability, because, well, it would be condos, but they're buildings like that. He said, because there's so many security issues in places like downtown Vancouver and downtown Toronto right now around big high-rise buildings. It's more about, it's not so much about having less security, it's about having better rentability. So show me a product that gives me better rent. I'll pay more for that, because otherwise I'm going to lose clients. So I always thought that it would, I think at the end of the day, it still comes down to money. But there's a combination, there's a demand out there for a service where you can provide it, you know, all of those pieces that we were talking about. You can provide all that and show a better product. I think there's a real opportunity to sell that going forward. I mean, that's what we're going to do over the next many years here as we build the business organically.
Perfect. Okay, so a few more questions here. Dan asks, how should we think about capital allocation to support that cross-selling of electronic services to Logic's customer base? Are you guys, is it sort of cash intensive to do that cross-selling?
We have a marketing team in our electronic services division. It's actually fairly efficient, because we have the clients, and we have we're in touch with all the procurement people all the time anyway. In terms of capital allocation, we may spend a little bit more money in the future with salespeople who can specialize in telling that story. That's really that's what it takes. But somebody has to do it, because we don't have a lot of extra people laying around in our business because we run it tight. But we may allocate a little bit of money on the sales side into our electronic security group so that they can cross-sell. Making the connections and the warm handshake introduction is easy. but you still need people to do it, close those deals. And so there's potentially a bit of a capital investment there. The other thing that we can do, because we have the balance sheet for it, is companies don't want to put up, $100,000 for a new access control system. We can finance that.
Right.
For 15 or 20%. It's a good use of my cash. If I can sort of say, look, don't worry about that. We'll fund it. Give me a 5-year contract or a 10-year contract. We'll monitor it for you. So we make money on all of that side, but we can also make money on the financing side of it, which has a strong appeal to some of these outfits. So it's another piece in that puzzle, Paul, where we got all the organizational and operational pieces, but now we get the financing piece too that we can bring to the table. So there's a bit of a capital allocation there, but that's a nice problem. That's basically funding a new piece of business.
Yeah, exactly. Russell asked the question that almost every CEO gets sooner or later is, what's your end game here? You sort of mentioned that these type of businesses, if you get big enough, somebody comes, knocks on the door and says, hey, here's a check. Is that what you think might happen here?
Yeah, I hear that question all the time. I ask that question all the time, and I'm always interested in the answer. And I think I told you guys the story. My dad always told me, fall in love with a good woman, and an asset is an asset.
Yeah.
So we're in the business of building a company profitably and running it tight. I mean, we do all that stuff really, really good. But at the end of the day, it only makes sense if somebody can sort of get liquid on that, including me. Like, I've never sold a share. One day I may want to sell a share, but I don't need to. But you have to be able to exit. So I'm not under any illusions that one day we will probably become a target. In the meantime, we're dressing the bride so that, and I know what the big guys are looking for in terms of their metrics and their models for acquisitions. So we're dressing it accordingly. Plus, it also is good business to do that. So that one day when they come knocking, we'll get a premium price. But we're not going to sell for like a goofy low price. We get lots of goofy low offers all the time. But why would I do that? I mean, we've got more cash in the bank than our stock price is trade. It doesn't make any sense, but that'll all itself one day, I know. And we'll either get taken out or we'll just keep getting bigger. It's really not any more complicated than that.
Yeah, no, it makes sense to me. Jesus asks, is there any seasonal sort of seasonality in this business?
A little bit.
Okay.
It's not. So we're not so much an event-driven business. Like lots of event-driven business, like a lot of event-driven security companies have bigger summer business, allocations. I would say that we're probably, summer is still strong for us because we do the City of Toronto contract, for example. So whenever there's all the festivals and stuff, like we do the security around all that kind of stuff. So that gets big in the summertime. And we do that across the country. But for the most part, I would say the seasonality is, the first quarter of the year, January, February, March of the calendar year is usually the slowest quarter. Having said that, though, this year it was our best quarter. I mean, so we're growing is the issue. But if there was a seasonality, I wouldn't over rotate on sort of trying to peg that. I would say, but that would be the lightest quarter for all security companies out there. But this year, we got lucky and we got some additional business and kept it growing strong. Plus, we use that time for really fine tuning turning all the dials and getting our receivables down, getting our DSOs down, getting our systems and everything humming and our overtime down. That's when we do that. So we create a stronger business going into the other, more productive months. But I've already talked. I've given it more airtime than it probably deserves, because there isn't really too much seasonality in our business, not ours anyway.
Yeah, and I have to imagine there's an advantage in sort of size, right? The bigger you get, are you able to bid on bigger, contracts, or am I wrong? Like, what is there an advantage to being bigger and growing from here?
Absolutely. When we being bigger from a revenue and a business size standpoint, there is a benefit to that, but because companies like bigger deals like to be able to see a larger balance sheet that they're going to, like, if you're a national contract, you like to see somebody with a bigger balance sheet bidding on it. Sometimes that's a prerequisite to filling in the RFP. So there's, the size that we're at, if we're north of $100 million, that's lots. The other thing I will say is that we are national now. With the deal that we did with Logix, we have an operation in every province. And so we can bid on national contracts. And that slide that I showed you, I'm going to just push it. I don't know if I can show it again here. But this one right here, like a lot of these guys have national offices. And so, we can like Coca-Cola, we can supply operations all across the country. And so that has value when you're bidding on larger deals. We have access to larger deals. We've got the balance sheet that we can fund the larger deals. So we think we're nicely positioned to sort of have some growth there, because typically these are contracts that are left just with the for the benefit of the really, really big guys. We've got access to all of this now because geographically we've got coverage, financially we've got heft, and we've got a strong balance sheet that allows us to fund the receivable.
Awesome.
And that's one of the, just if you don't mind, one other point I'll make on that is one of the things, because we all offer pretty much the same kind of service. One of the advantages that we have is because we have a strong balance sheet, we can offer terms to clients, which is in many cases more important than anything to them, that they get longer payment terms. So you can give somebody 60-day terms to pay, and that's a good thing, and oftentimes it's a difference between you getting it and somebody else getting it. And so we don't mind that. Now we build it into the pricing, but they don't care about that. If you can give them another 30 days to pay, lots of times guys won't matter, and that'll be the difference. So we kind of have all the pieces, if we do this right, that we should start to really hum in the next little while.
Yeah. And then what's the biggest challenge you face running the business?
I would say, I'm not going to complain, but I mean, the market is, this, I mean, the market is a goofy place right now in terms of recognizing value. So we spend all of our time, I try to not spend any time, although I own a big share of the company. At the end of the day, we're a simple business. We make cash. And getting the market to realize that, we're not going away. We're like a little cash machine with no debt. And we're boring. We're a simple business and we're boring. Those are all, I think, strong advantage points that the market, even though I think they like it, we're not the flavor of the month at the moment. And until that worm turns, we probably won't be.
What's your favorite part about running this business?
Well, that's a great question. Usually you get the other one. What I like about we're a people business. Like I say, we got 3,000 employees. I got a great team. When we started this business, I'll never forget when we started this business 30 years ago, like long time ago, because I've been in it for a long time. One of the things we used to have to do, I mean, I'd be standing at the front desk waiting for the checks to come in from the clients so that we could rush them down and make payroll, because it was, left, pocket, right pocket. We're not in that position now. We operate differently because we're well capitalized, and it's our own money. So we're not, I don't say we're not comfortable, because that's not a good thing. We are careful, and we're good capital allocators. We know how to make money. I much prefer operating a business the way that we are right now, which is well capitalized. It makes us run the business better and more for the long term, and that's good. I mean, we think we're big shots, but I mean, we're small in the real world. I mean, there's guys out there that are 100 times our size or more than that. Well, one day they'll buy us, but that's okay. In the meantime, we're still a lot bigger than a lot of those 50-man guard operations, and if they want, they can sell to us.
Yeah, exactly. Okay, last two questions, sort of, just as investors, sort of what should we be focusing the most on in this business? Like what kind of metrics or maybe what catalysts do you think are important to really watch out for to know what you guys are doing?
Well, I think, like I'll tell you, the most important questions I ask all the time: what's our overtime?
Mhm.
You know, we run sub 3%. The industry tries to run sub 3%. When we bought Logix, for example, it was running at about 8%. That all comes right off the bottom line. Running the shop carefully and precisely, and that's not, I'm not casting aspersions on those guys. It was a different time, different place, and their capitalization was different. We've got the systems down now where we've got a good strong bench. We've got a good strong management team until something changes, and that'll happen. And so that, you know, that makes things a lot. It makes things a lot better in terms of running an operation like ours day to day. And I think we're in a pretty good spot that way. And I don't know if that's exactly what your question is right now, but I enjoy working with the people. I enjoy being well capitalized because we can make good decisions, good long-term decisions. Because I've seen the other side, and I prefer this way. And I can make more money for investors, frankly, which I'm one of the largest ones on this. So I can make more money for investors with the shape that we're at today in our business. And I like that. I mean, we got a business that's not going away. The industry is not going away. The opportunity is not going away. We just have to be positioned and continue to position ourselves in a way that we can take advantage of that. I think we are.
Yeah. And then just last question, kind of open-ended. Is there anything we missed, or is there any key message you want to make sure everybody walks away with today?
Just that we have no debt. And that's a mantra of ours. We have no debt. We're a cash business. We're simple and we're boring. If that's what you like to invest in, then come along for a bit of a ride. If you want somebody that's going to pour gas on a big flame with a bunch of debt, we're not the place to be. But we're also not going away. So no, I think you pushed all the right buttons and got all the right stuff out of me, I think.
Right on. Right on. Doug, it's always a pleasure talking to you. There's some wit and wisdom in there when we have these conversations. So I appreciate the time. We've been speaking with CEO Doug Emsley, SSC Security Services, symbol SECU on the Venture Exchange, and SECUF on the OTC. Doug, always a pleasure. We look forward to catching up in the near future.
Likewise, Paul, and all the best to you and Trevor and the team. And thanks very much for the opportunity. Take care,
You
man.
got it. Thank you.
I know.